Hello and welcome to this week's episode of Companies and Markets Weekly from Stockopedia. Just quickly before we get in, I want to thank everyone for their reaction and their feedback to our first episode last week. Really, really grateful for everyone who's taken the time to go and rate us on their podcast platforms, leave us a review, leave a comment on the survey that is linked in the episode description. We do read every single one. We had some feedback about the audio levels last time. Pointing that out, really had some really good conversations with people about how and where they were listening. Hopefully we have fixed that for this episode. So hopefully you have a better experience listening to us. This week in part 1, I'll be joined by Graham Neary and Roland Head. Then Megan Boxall will be joining us for parts 2 and 3. In part 1, we're going to run through what was quite a sparse week of news headlines. So Graham and Roland are going to hopefully shed some insights onto some of the companies they were reporting on in this week's daily stock market reports. In part 2, we're going to run over an article that our colleague Mark wrote on translating some of the language that's used in the stock market, in trading updates, in management presentations. It was very, very funny. So we're going to share some of the slightly cynical translations that he came up with. Part 3, we're going to pick a winner of the week and then look ahead to what's coming up on Stockopedia over the festive period. Graham, hello.
Hello, Lawrence.
How are you?
Nice to be here. Very good, thank you. How are you?
I'm all right. How are you, Roland?
Very well, thanks. It's great to be back here again.
Good. I'm very glad. Shall we kick off part 1 with... I want to start by talking generally about takeovers, because in the daily stock market reports this week, highlighted a couple of companies, National World and Intelligent Ultrasound, that were subject to some takeover bids, but also more widely in the news, it was reported that Czech billionaire Daniel Kretinsky's takeover of Royal Mail, or was it now International Distribution Services, is what it's called, £3.6 billion takeover, approved by the government. It's a very small premium, I think, to where it was currently trading before the takeover. I've never held shares that have been subject to a takeover, fortunately or unfortunately, I can't tell which. But I know I've seen comments from our subscribers around other takeovers where they've held shares, going basically asking what the process is from their perspective. Obviously, they hold shares in an ISA, a SIP, a brokerage account. Those shares are being bought. Do they have to do anything? What's the process like from a DIY investor's point of view?
Okay. Well, I would say that very little action is required. Voting on the deal is not necessary, but of course, shareholders may wish to vote on the deal, and depending on which broker you use, that may be easy or difficult to do. But I suppose the main decision is whether to sell on the news, and there's a lot of different variables there. So the question would be, how likely is the deal to go ahead? How happy is the investor with the proposed price? And what is the difference between the share price and the price at which the deal is supposed to go ahead? So you can see there's a lot of different factors there. Nothing is mandatory. You can buy, sell, vote, or not vote as you wish. I think many investors do like to sell, or at least partially sell some of their holding to cash in and take some of the risk off and get into something that's more interesting. But that's totally optional. Personally, I would hold on and wait to receive the money, because there's usually a discount between where the share price is and the deal price. So I would hold on for the full amount, but every situation is different.
Roland, have you had any brilliant takeover offers in your portfolio?
I've not had any for a little while. I did have a couple last year, but I tend to lean towards selling if the price is reasonably close. I suppose for a couple of reasons. Firstly, the offer isn't necessarily guaranteed to go through when it's initially announced, but more really because there's a time value of money to, an opportunity cost to holding. And it may be often I can see that I'm ready to, I've got something else perhaps in mind where I'd like to use the money. So it might work out better for me just to move on really. There's a case for taking both approaches or either approach, and there's no hard and fast rule. If you do nothing at all, the cash or the shares that are being used to fund the takeover should eventually just arrive in your brokerage account normally.
I guess it's this is a point where it might be useful for people to have an idea of the sort of target price for a share and whether that takeover bid comes close to it or not.
Well, there's always the possibility a higher offer might emerge. That's probably more likely in some situations than others, but it certainly does happen, and it's not always predictable at all from an outside perspective, I don't think.
Also this week we had ShoeZone, which is a smaller UK retailer of, funnily enough, shoes. They issued a pretty severe profit warning. They adjusted their expectations for profit before tax for the financial year 2025. They halved that from £10 million down to £5 million. They blamed poor weather, weakening consumer demand, and significant extra costs due to the increases in both national insurance and the national living wage. Graham, you said in the report that we may well need to watch out for more warnings like this in the near term as companies come to get to grips with some of these increases in their cost base. If I'm looking at my portfolio and I'm trying to identify sort of at-risk candidates, what could I look for to help me identify those?
Well, really anything with a lot of employees and without enormous profit margins. So typically retail, hospitality, leisure, these sorts of things are obvious candidates. ShoeZone itself, as far as I know, did not say that they would be able to mitigate the higher employment costs, but their broker did assume mitigation in their forecasts. However, after this profit warning, the broker came out and said, actually, we no longer expect that the changes can be mitigated. And I think perhaps some of us, including me, have been a little bit too comfortable with the idea that higher national insurance and minimum wage costs can easily be offset with efficiencies, because if it was so easy to find these efficiencies, why would they not have been done already, would be my question. So maybe we do need to be a bit more careful now.
What are the ways in which a company could mitigate against these increases?
Well,
obviously very company dependent.
What I mean, the first thing that comes to my mind is cutting back on some benefits, on some employment benefits that may have been given out. That's the first thing that comes to my mind. Changes to how people are rostered, changes in terms of flexibility. I mean, those are the things that come to my mind straight away.
I suppose one other possibility as well is that they'll take a more critical look at their store estate, at the profitability of different stores and different types of stores, because I think they have more than one category of shop, some larger formats and some smaller ones. And I know the one nearest to me has closed in the last year or so. And so perhaps they might get rid of more of their smaller shops. I imagine they might be more labor intensive relative to sales. Possibly.
We also had IntegraFin reporting this week. Roland, you covered that's 1.3 billion market cap. This investment platform for financial advisors apparently delivered a 10% rise in pre-tax profit this year, or last year, sorry, with net inflows of around about 5% of its opening assets. Roland, you said that their platform's got good scale, The group's quality metrics are remaining high, but you've got some concerns about competitive pressures. Can you speak to those?
Yeah, well, IntegraFin's relatively unusual because they've chosen to provide their platform under their own brand, Transact it's called, targeting mostly independent financial advisors. Now, there are a number of other companies that have similar software offerings that serve the UK market, but what most of them do is they kind of offer their platform as a white label, if you like, or a service they offer to other companies who don't want to produce their own. So some of the biggest advisor groups in the UK are like Quilter and Aberdeen. They use another company's technology to do what IntegraFin does, but I suppose the difference is that for IntegraFin, they're probably not going to be able to get into those. They're not able to target those markets where the advisors are tied to a single branded business. So my feeling is it might be harder for them to gain more market share beyond a certain point, simply because the bulk of the competition is tied into other platforms already. But having said that, I think the company says there's still they've got about 8,000 advisors signed up, and they think there's still up to perhaps 5,000 that they could target in the UK. So there's still theoretically plenty of potential, but I think that could be just a constraint on growth. It might make it harder for them to outperform the wider market going forwards. But I think it's a good business overall.
How big are these other competitors? How big and powerful are they?
Well, if you look at the company, the technology provider that serves Quilter and Aberdeen and also Aviva and Scottish Widows, so the four quite big names, that's a company called FNZ. And the across those four companies, across those four clients, I should say, they look after multiples of the asset value that IntegraFin has on its platform. So they are substantially bigger, and we might argue that their costs are proportionately lower, or that they have greater economies of scale. So it's something to watch, I think, but I don't see it as a real pressing concern immediately.
We also had an update from a much smaller company called Insig AI this week. I noticed that looking at its stock report, it had the unholy trinity of being classified as highly speculative, microcap, and sucker stock according to our ratings. Graham, you said that this was a slam dunk red rating, according to our red, amber, green ratings on the reports, due to its weak balance sheet, a material uncertainty warning about its ability to continue, and a potential overvaluation due to its association with the AI bubble. Do you want to stick the boot in a bit more?
I don't like to criticize companies if I don't have to, but there wasn't a huge amount of news this week, so this one came up on the radar, and I just noticed. I mean, it only has a £17 million market cap, but it published an RNS recently where it was trumpeting a contract win, where the value of the contract was £80,000. Even at the very bottom end of small caps, this is a very small contract win to write an entire RNS announcement about. And besides that, it has all the other red flags, a going concern warning in the results, where there's an uncertainty about its ability to continue as a going concern, very low cash balance, I think £500,000 or so. So yeah, and also association with the AI bubble. So absolutely one that I would be vigorously avoiding.
Boasting about an £80,000 contract win sounds a bit like me when I boast to my wife that I've unstacked the dishwasher that morning. Finally, we're going to finish up with a festively appropriate company, Artisanal Spirits. Graham, again, you took a look at that this week, and you noticed it's claiming to have some very, very expensive whiskey on the books. Do you want to chat a bit more about that?
Yeah, sure, Lawrence. This is one which I had not studied before, but it turned out to be reasonably interesting because they say that their whiskey inventories are worth about £100 million. So there were two sector experts that they hired to value this, and it's these experts have come back and said that it's worth £100 million. It's an appreciating inventory base, which is not very usual. You don't usually find companies where the inventory is growing to this extent. Um, Now the market cap is about £27 million. Last time I checked, they did have some net debt which they used to build their inventories, but now that they're saying that they're moving into the cash flow positive stage of their development. So I think it's an interesting story. I haven't got a firm view on it, but if somebody has an interest in whiskey and thinks that they can agree with the statements here, it could be worth another look. It is expected to remain loss making for the next few years, but it's growing its membership base. It sells membership to this Scotch Malt Whisky Society, and so these thousands and thousands of whiskey aficionados are paying membership dues in order to access new whiskies and events, tasting new whiskies. So it's an interesting little story. I've no idea if it's true that the whiskey is worth £100 million, but it's intriguing.
I wonder whether or not that number was come up with after a tasting session. That would be my bet. I know I'd heard of the Scotch Malt Whisky Society before, and yeah, it's a membership. You get sent miniatures of very, very sort of old, rare, expensive whiskies over time. They are all sort of own labeled, so you won't be you'll know what distillery they've come from, but it won't be packaged as if it's come from that distillery. It may be a really nice way of sort of augmenting the amount of revenue you could get from that inventory as well by selling it in smaller portions like that. That's all we've got time for in part one. We'll be back in part two, joined by Megan Boxall, where we'll talk about deciphering some of the language that you might see in trading updates. Hello, we are back for part two. We're joined by Megan. Hello, Megan.
Hi, thanks for having me.
You're very welcome. We are going to chat through an article that our colleague Mark wrote called Translating the Market Lingo. Very, very funny article. I will link it in the episode description. Mark has gone through, I don't know how many different phrases that you might see in trading updates, company results, management buzzwords, strategy updates, broker recommendations and analysis. He's applied a somewhat cynical translation to each of those. Would highly recommend reading it. But I think it speaks to maybe a bigger problem in terms of the accessibility and the sort of the communication style within the stock market. How do we get around this problem?
Well, first of all, I think Mark wants to make it. Mark, he said it a few times. He said it a few times to me. He has said it in response to a comment as well on this article. He wants to make it clear this is a tongue-in-cheek article. It should not be taken for educational purposes. I agree. Like, it is a funny article. There's a few little elements in it which he's obviously taking the mickey a little bit. I think he's got 4 or 5 different definitions that various companies use for discounting. He describes when people say things like teaching, it's just presentation, but more pretentious. So yeah, it is a tongue-in-cheek article, but it does speak to a bigger problem, as you say, Lawrence, and something that I struggle with. I think from a I don't know about Roland and Graham how you feel, but when I'm reading some company financial results, trading statements, I do so with a slightly cynical mind, because I think I see a phrase like, I mean, to me, actually, the one that really winds me up is adjusted EBITDA. I hate it, and I see adjusted EBITDA, and if that's on the top line, I think, what are you hiding?
Yeah, Mark said on adjusted EBITDA that trading is so bad that we couldn't even make up a positive number.
Yeah, I always think companies reporting an adjusted loss, it's like that. It is a little bit optimistic, but when I see adjusted EBITDA, I always think, what's the real profit, and more importantly, are you generating any cash, which is sadly not always the case. But
why is it that companies are so keen to hide, massage, or outright sort of obscure what's actually going on? And I think follow-up question to all of you: are there any companies that you can think of that don't do this, that actually communicating really, really well with the market?
So I would say that it's really just experience is the way to deal with this. As you spend more time, learning about investing, you realize that there's a lot of PR, and probably through bad experiences, you'll realize that PR can sometimes be damaging if it paints a picture, and if you don't have the necessary skepticism, you can get sucked in. I like the way Mark included profitable growth in the article, because that is extremely common nowadays. Even very good companies have started throwing this phrase in as if it's an achievement to say that they're looking for profitable growth. All it really means is that the company might grow its top line, and maybe it has positive EBITDA, and that's all a company really needs in order to say profitable growth. Companies that don't do this, some small companies, family-owned companies that don't care about their share price, they don't bother with PR. A big company that I own is Next. I think they're pretty good at avoiding meaningless PR in their statements.
Yeah, Next is definitely it's often the go-to, isn't it, when people talk about companies that do reporting very, very well. And I think one of the things, I mean, there's a few things to talk about within what we're talking about here, but while we're talking about Next in particular, something that's good and quite interesting about Next is that they do tend to hit expectations. They very rarely disappoint when it comes to reporting their numbers. And I think that they are a real lesson in managing expectations. They don't fill their reporting with fluffy language like profitable growth and words that don't actually mean anything. So I feel like you're more likely to know what you're getting. There are very rarely nasty surprises. And if there are nasty surprises, management does do a good job at explaining why profits may have been down, sales may have been down, margins may have been down. And I think they are a really good lesson in good communication with the market. What I don't understand is why more companies don't do it. Like, we always have to lean on Next as an example. Games Workshop is another one. If you're looking for a slightly different take, JD Wetherspoons, they're pretty open and honest, but maybe for different reasons. But why aren't more companies reporting like this?
I think there's something there in the under promising and over delivering. Like if you flip that around, I think you see a lot of companies over promising and getting that capital up front and then having to sort of manage expectations on the way down, which is where a lot of this language might come in.
Yeah, that's probably true. That they've put they've been as optimistic as possible, and then I suppose you wonder sometimes if they're optimistic in the hope that things will go to plan, and then if they do, all well and good. But sometimes, as you say, management the expectations have to be managed down a bit. But actually, going back to Next, one thing I don't know about Megan and Graham, but over the years, really, if you read the detail of what they write, it's really quite educational sometimes. You learn a lot about how the business works and the finances of it. It's rather than sometimes you read an RNS and you have to really struggle to understand what they mean. With Next, it's more the opposite. The explanations are of a very high quality, and it can be a useful insight into business, not just into Next quite often.
Yeah, I mean, another company I own is Berkshire Hathaway, and obviously those annual reports are like, it's like reading an amazing book about finance, or it's like a real educational lesson reading them. But if you ask why, Megan's question was very good. Why aren't more companies communicating effectively and properly? Well, I would say that most CEOs and most management teams are, they're hired guns, if you like. There for a few years and then they leave. And they will do what everybody else does: hire a PR company to help write the reports, and the PR company will try to make things look as good as possible because that's their job. So I think the only defense against it is to have management who are really clued in and who really just want to be honest. And that is not going to be most companies, probably.
Yeah, I think that's a good point, and I do think that some of the companies that do reporting well, the chief executives that are doing that reporting well, or the chairman, they're often founders, or they've been at the business for a long time. I think Kevin Roundtree at Games Workshop is such a good example of someone who clearly loves the company so much. He's been there for such a long time. He's been the chief executive for a very long time, and his financial reports are really, they show the passion, they show the love of the business, and they're really clear, they're really easy to read. There's another company in the US which I hold, called Cognex, and their annual reporting, I mean, I hate to say it because it's very much not the Stockopedia way of investing, but it was the annual reports that really attracted me to the company, because the way that they're done is just brilliant. The founder stepped down a couple of years ago, and they do Cognex do a photo shoot every year, and it's some sort of pop culture reference, and then the annual report is all like set up around whatever that reference is. So one of them, I can't remember which year it was, I think it might have been 2015. It was a conversation between the founder and chief executive at the time, he dressed up as Doc Brown from Back to the Future, had gone back to 1985, which was the year he founded the business, and was having a conversation with his previous self, and how proud he was of the 30 years of the business. Yeah, it must have been 2015, because it was all like around Back to the Future. I just thought it was great. Like, I read almost the full annual report because it was so interesting. I mean, who reads a full annual report? They're hundreds of pages. So yeah, I mean, it's had a shocking time, Cognex, I would say, since I bought the shares a couple of years ago. So maybe picking your shares based on the layout of the annual report isn't the right investment strategy. But I like companies which are delivering. The chief executives are really delivering a good, clear message and clearly care about what they're doing.
It feels like finding companies that clearly put effort into making their communications engaging and easily engaged with, rather than the flip side, which is kind of including lots of language to obscure what's going on and to make people sort of gloss over it and go, oh, this sounds nice.
I generally find, I think if there's something I read enough times and I can't understand it, that's almost a reason not to really consider going much further, because it shouldn't be that hard. Business isn't generally rocket science. It isn't that hard to explain what's happening if you want to explain it clearly. And I tend to think sometimes I'm reading something and I think it's just been written to make it to try and blind the reader with buzzwords or confusing jargon or a convoluted explanation, and there's not really any reason for that, or at least not really any positive reason for that, I don't think.
On that note, we're going to wrap up part 2. We'll be back for part 3, where we're going to look at our winner of the week and look at what's coming up on Stockopedia over the festive period. Welcome back to part 3. Our winner of the week this week. I don't know if it's quite right to say winner of the week, given that it's actually been a 10-year process. Our CEO Ed published an article this week about his no admin portfolio system, reviewing 10 years performance of it, because he's been running it for 10 years consistently now. It's compounded at a 13% annualized rate. He says it's also beaten every UK fund manager, all the UK indices, and the S&P 500 just by investing in UK stocks. The process, if you are not initiated, is Ed takes the UK stock market and sorts it by our proprietary stock ranks. He excludes some small and hard to trade shares. So anything below 20 million pound market cap. And I think there is a bid-ask spread rule that he includes in there as well. He selects the top 2 stocks from each of the 10 sectors. So 20 stocks in total, buys that list, holds it for 1 year, rinse and repeat. And as Ed showed in his article, it appears to have been phenomenally successful over the last decade. Panelists, what have been your biggest investing lessons that you can take away from a process like this? I'm curious.
I think for me personally, and something that I have done more myself over the years, is really about being consistent with the methodology and the decisions you make, not being tempted to chase whatever might be hot at the moment or different trends in the market, but just really having a consistent approach that you understand, you believe in it, and you just keep repeating it, even though at times it may not seem to be working as well as some other people's methodology. But the consistency for me, I think, and I think that's the NAPS has really demonstrated that.
Yeah, I really like the way that each sector gets a piece, because my personal holdings and my watch lists tend to be concentrated in sectors. So it's nice for me to see somebody who's just buying every sector and it's doing really well. So I like that because sometimes some sectors in the market, say commodities, I sort of I look down on them a little bit. I say, oh, you can't do so well in commodities, but actually this portfolio is just buying everything and doing really well. So I like that.
Yeah, I agree with both of those points. But and I think another one that I find really interesting is the very disciplined holding period. So the portfolio is turned over entirely every single year, and Ed is very disciplined about that. There's no hanging on to the shares in the portfolio just because, oh yeah, I quite like that one. There's very little emotional attachment to the shares, and it's something that Ed and I really, really differ on our approach to investing. Ed doesn't really have that emotional attachment to shares, which, as I've just said, Cognex was not a great choice. But I love it. So I think, I think having that really disciplined, turning over the entire portfolio every single year, regardless of how the shares are doing, it has meant that there have been some stocks which have continued to win, which the NAPS portfolio has missed out on. Like it held Games Workshop for a year and sold it, obviously, because it does sell stocks at the end of a year, but it hasn't mattered in terms of the performance of it. I think it's, despite the fact that there is the odd stock that it may have sold out of too early, it sold out of many, many more that would have ended up losing the portfolio monies. And I think So yeah, that holding period is a really interesting lesson that I have learned from the NAPS process.
I think for me as well, I think this is exemplified by a subscriber comment we had underneath that article. It's been the efficiency in the whole process. Like, so John Smith 68 said that he joined Stockopedia in December 2016. So he's followed the system with interest along the way. He said he could never get on board with it because he's too addicted to the daily soap opera of private investing. So the idea of setting and forgetting at the start of each year would be unbearable. But then he goes on to say his past 10-year performance has been about 300%, including all dividends, which comprises apparently about a quarter of that total return. The 250% return of the NAPS, the no admin portfolio system, doesn't include dividends. So you can add quite a substantial amount extra onto the top of that. And he says it's made him realize that he would have done just as well, if not better, with a single hour of admin a year across the entire decade versus the countless hours that he has spent generating the performance that he has done. So that I thought was an incredibly interesting comment. Thank you to John Smith for leaving that one. John
Smith's on fire at the moment. John Smith also asked me to look at GSK, which I then did. So yeah, John Smith's having all sorts of influence in our content. It's great. Keep them coming.
Keep it up. Before we jump ahead to the content that's coming up from us over the festive period, it's probably worth us touching on a couple of macroeconomic announcements this week. Graham, you were looking into, in the UK, we had unemployment figures, inflation, and the Bank of England rate decision. And in America, we had the Federal Reserve rate decision as well. Do you want to speak a bit about that?
I just thought I'd mention the Federal Reserve because it had a really big impact on Thursday. The Dow was down 2.5%, and the UK was down about 1% on the back of changes to what people are expecting next year. So next year, we can only look forward now to 2 rate cuts, whereas previously 4 rate cuts were expected from the Fed. Now, the good news is that I don't think this really affects most of the companies that I cover, but it's just sort of an insight into market sentiment that a lot of people reacted in a big way to this news. And in terms of the reasoning behind it, it just seems that the Federal Reserve is still not satisfied with where inflation is. Inflation is still a little bit too high. So there's that sort of big factor. And then there's, of course, the Trump presidency, where there are elements of uncertainty there. Could tariffs increase inflation? And would that be a reason for the Fed to keep rates higher for longer? So it had a big impact on market sentiment on Thursday morning, but I think in the long run, if you look ahead to 2026 and 2027, it looks like rates will be more or less on the same path that they were before this sort of smooth move lower from the Fed. So that's the update. Hopefully not a big impact, but in the short term, there was a big impact on sentiment.
So lots of uncertainty stateside. One area where there is much less uncertainty is in the content that's going to be coming up from Stockopedia over the next couple of weeks. Megan, do you want to let the listeners know what they can expect from us?
How's that for a segue? That was
I know.
Very impressive. Yes, I can let you know what to look out for. Mark's written an article. It's actually quite moving after his funny article this week. It's about the nature of risk, and I highly recommend reading it when he publishes that next week, because it's a really nice piece of speculation about the year just gone. Ed has also done some research. Ed's actually in Australia at the moment, and he seems to be awake all the time. So he has been doing some research into the performance of the actual stock ranks. So obviously he's updated the NAPS portfolio specifically this week, but he's looked more broadly at the highest ranked stocks, so 90 plus ranked stocks in 2024. So he'll be publishing that. And then our main sort of Christmas feature is watch lists and the companies that we're all excited about in the coming year. So Mark, Graham, and I are looking at we're looking at watch lists quite broadly. We've all got slightly different takes on the way we look at the market. So we'll be publishing what we're calling 12 stocks of Christmas. So look out for a short piece of analysis on 12 individual stocks a day from the three of us. And we've also, probably slightly more interestingly, I guess, is the looking at the stocks that Roland and Ed will be doing, which is slightly more portfolio based. So I'll just speak quickly to what Ed's doing because he's not here. Ed is looking at an iteration of the NAPS portfolio. He sort of hinted at it in the article that he wrote last week. It will be hopefully very, very interesting and still sort of similar sort of strategy, similar sort of structure, but with more touch points throughout the year, which we hope will be useful for those of you who like to engage with your stocks more regularly than once a year. And Roland, I'll let you explain what you're doing with your model portfolio.
Yeah, that's right. So I've run the stock in focus or the SIF model portfolio for about eight years now, and the focus, it's always been a systematic approach where I use the screen to create a short list of stocks that I can select to add to the portfolio, and the focus has always been on what I've called affordable growth. So really just a moderate valuation and evidence that there's a prospect of near-term earnings growth and hopefully share price momentum. And so what we're going to do from next year onwards is just increase the weighting of that portfolio a little bit more towards income. It may sound like a big change, but actually it may not be as big as it seems because the portfolio has always generated some income. I think it's probably averaged out at about 3% annualized over the years. So what I'm going to be doing is just tweaking the rules slightly and looking at the general approach to try and increase the level of income without sacrificing, hopefully, too much capital growth.
Yeah, I found that really interesting actually, Roland, when we were looking at sort of the fact that we wanted to launch an income portfolio. It's what you've done is not that far really from an income portfolio. As you say, it's not a huge change, but yeah, hopefully it will satisfy the people who are looking for income in their investing.
All of that, of course, will be available on Stockopedia over the festive period. I know there's a lot of people listening who are already subscribers, so thank you very much. If you're not already subscribed and that has whet your whistle, you can head to stockopedia.com. We do have a free trial available, so you can try it all out over the Christmas period if you have nothing else to do, of course. On the podcast front, we are still going to be publishing podcasts over the next couple of weeks. We're going to be publishing one next week where Megan and I take a look back at the year that was 2024. And then we are going to kick off 2025 on January the 3rd with a look at Graham and Megan's watch lists. That's all we've got time for this week. Graham, Megan, Roland, thank you all so very much for joining me.
Thank you.
Thank you.
Thank you.
So there's an awkward silence there where everyone nodded and figured out who was going to speak first. I just want to wrap up by saying, again, I started this episode with a massive thank you to everyone for listening and their reaction to this new venture from us. I wanted to share that we have spent most of the last week in the top 5 in the UK business charts on Apple and the top 10 in the comparable chart on Spotify, which is incredible. I've had a look at our analytics. We've had listeners from 29 different countries around the world, which is awesome. So again, massive thank you from us. If you haven't done so already, we'd really appreciate it if you could leave us a rating on whichever platform you're listening on. If you have the ability to leave a review or a comment, that also goes a really long way to helping other people discover the podcast and benefit from it as well. We've had some lovely feedback from people. A user called Grout123, which is an excellent username, said he looks forward to listening regularly. Another great addition to the content offering from Stockopedia. Thanks, team. The Ox2906, thanks to the podcast, guys. I enjoyed it. Content was excellent. And Ed66, I don't believe this is our CEO having a shadow account, but Ed66 said, thanks to the podcast. It's sure to become a regular weekly listen. That's all from us this week. Have a lovely week next week, however you are celebrating, and we will see you back on December the 27th. Thanks again.